I posted shortly after it became the new day, as today represents the exact same amount of time as the length of the 2018 through 2021 bull market to the day. But in today's video, I'm going to really dive into what ultimately led me to the decision of being at 50% cash. This decision was not taken lightly. I haven't had a day off from crypto in a couple of weeks. And every day feels like they've been 12 to 15 hour days for weeks on end.
Yesterday, we saw the single day largest Bitcoin correction out of history.
I have lost millions of dollars over the past 48 hours.
Guys, and it's not looking amazing. I lost like $5-6 million, guys, on this move. Wiped out.
I lost millions of dollars. If I made some quick calculation, open positions with unrealized gains, it must have been at least $6-7 million that I lost.
And I'm gonna be fully transparent since I'm doing this $1 to $10 million challenge. I was sitting on $3.4 million on this trading account, and now once again back towards about $1 million.
The problem is, because I got liquidated literally at the very bottom, I wasn't able to stay in that position and take profit on the way up.
Mr. Donald Trump making an announcement that for some reason cascaded the entire crypto market into the worst crash we've ever seen.
I lost more than you. I lost probably, let's say, 7 million. Maybe you lost 70,000, maybe 7,000. Long story short, we're all in the same boat. We all lost a lot of money.
And while this was happening, we recorded the biggest liquidation event in Bitcoin's history, even larger.
There are some differing
even 15
opinions out
times
there
larger
about
So
than
that
the
is what
pandemic
annoys me the
crash,
most.
about
If I just
13
would have
times
added a
larger
little bit
than
more
the
margin,
Now,
all
I
my
lost
positions would have
almost
survived.
Almost
Now,
every
let's look at
single
what I
position
still
I had
have, guys, and it's
open.
not.
Hey guys, and welcome back to I'm Studying Life. Today we're doing something different. A mini documentary exploring the biggest liquidation event ever recorded in crypto history. We'll walk you through how we got here, what major crashes taught us, and whether what's being shown to you is the full truth. You'll come out knowing how liquidations work, how the system can be manipulated, and what to watch for next. If you're ready, something real, hit like, drop a comment, and let's get into this one. Okay, so what actually happened? The trigger. On October 10th, 2025, President Donald Trump shook markets by announcing 100% tariffs on Chinese tech exports and controls on critical software, a drastic escalation in US-China trade tensions. He framed it as retaliation for China's export restrictions on rare earth minerals essential for manufacturing. Many in crypto and additional markets saw red, fearing a shock to supply chains and tech sectors. This announcement rippled through markets. Bitcoin plunged around 8%, and the broader crypto market registered an historic drop. But the tariff tweet was just the spark. The forest was already dry. Following the tariff shock, over $19 billion in leveraged crypto positions were liquidated over 24 hours, making this arguably the largest crypto liquidation event ever. To put that into perspective, previous massive collapses like FTX, Terra Luna, and even the crypto crisis during 2020 lockdowns didn't see this level of cascade in a single day. On Hyperliquid alone, over $1.23 billion in trader capital was wiped out. Around 1.6 million trading accounts were liquidated. Some altcoins crashed 60 to 90% within hours on certain exchanges. Bitwise's Jonathan Mann estimated that more than 20 billion were liquidated, with around $65 billion in open interest erased, resetting positioning back to July levels. To see just how wild this is, let's rewind and compare this to past crypto disasters. COVID-19 crash in 2020. During the global lockdowns, markets fell hard. BTC and crypto broadly dropped, but the liquidation scale was nowhere near what we just witnessed. The Terra Luna collapse of 2022. The algorithmic stablecoin failure crushed confidence, erased billions, and triggered contagion across DeFi. FTX collapse late 2022. That bankruptcy due to mismanagement and misuse of customer funds impacted market trust deeply. Sam Bankman-Fried was later prosecuted. Those events shook the crypto world. But the $19 billion plus cascade in hours, that eclipses them combined in sheer velocity and ferocity. Okay, here's where things get interesting. The narrative pushed by media is that Trump's tweets caused the liquidation. But correlation doesn't always equal full causation. A few things suggest deeper forces were at play. Let's look into these things. Liquidation requires forceful, coordinated dumping when many leveraged longs get squeezed simultaneously. For such massive cascade to happen, thin order books, margin borrowing leverage, and internal exchange mechanisms must align. Some reports have already questioned whether exchanges experience execution delays, order failures, or internal volatility windows during the event. Our suspicion, and the twist, is that the tariff announcement was a smokescreen for a coordinated move. A big market mover or group could have positioned themselves with shorts or hedges, then triggered panic. Perhaps a crypto exchange or insiders had privileged knowledge or infrastructure control to amplify the cascade. Look into the mechanics of a liquidation cascade. Got to focus on 1. Leverage buildup. Many traders use borrowed funds to amplify positions. 2. Trigger event. A shock, tariff, tweet, macro news seeds fear. 3. Margin calls and forced liquidations. Exchanges auto-flush leverage positions, starting with smaller ones. 4. Liquidity vacuum. Order books thin out as liquidity providers withdraw to manage risk. 5. Plunge continuation. With fewer buys, each sell pushes price lower, triggering more liquidations in a feedback loop. If a powerful actor had influence over exchange mechanisms, let's say setting mark price offsets, controlling futures funding rates, or coordinating stop loss triggers, they could manipulate the cascade to maximize profit. Combine that with the fact Trump stands to benefit politically as the tariff drama gives him cover plus influence in tech/China policy, and you've got a narrative that's too neat to ignore. So to wrap up this segment, what really happened? Well, on surface level, Trump's tariff tweet sparked a panic. But behind that, the plumbing of crypto, when you look at it from leverages to thin books, exchange controls, all this allowed the panic to morph into the largest liquidation event ever. And our view? This was no accident. The stage was set, the forces were laid, the explosion was triggered. In fact, in the middle of recording this, our assumptions and suspicions have just been proven correct, as President Donald Trump just tweeted this. Next, we'll break down the market reset and explain the effects this event had on the crypto market in its entirety. Okay, you remember the shock. One tweet, then chaos. Markets puked. Over 19 billion of leveraged positions were wiped out in about 24 hours. That number alone is jaw-dropping. The largest single day liquidation in crypto history. But numbers are one thing. The aftershock, the way the market's metrics rewired, is where the real story sits. So we're going to walk you through what reset, why it matters, who won and lost, and why a violent reset like this can actually clear the decks for the next major leg up. You see, when the cascade hit, a cluster of market indicators flipped hard. These are the ones pros watch every minute. Fear and greed index. This sentiment gauge swung from greed into fear. In some trackers, the index plunged dozens of points in a day, signaling a very defensive market mood. The fear and greed index cooled sharply after the liquidation. Liquidations, derivative wipeout. CoinGlass and CoinDesk and multiple data aggregators reported roughly $19 billion plus liquidated across futures and margin desks in a single 24-hour window. A record. That's not paper losses, it's forced selling as exchanges close positions. Open interest. The total size of outstanding leveraged bets collapsed as many futures were auto-liquidated. That drop in open interest reduces fingernail thin positioning and often precedes lower volatility later on as leverage is removed. Funding rates and basis. During the crash, funding rates spiked or flipped negative on many perpetual swaps as short longs rebalanced. Abrupt funding rate moves indicate that funding costs to hold a leveraged position changed drastically, discouraging new aggressive levered entries for a while. Dominance and market breadth. Bitcoin dominance surged initially as many altcoins collapsed far harder, some down 40 to 90% intraday on thinner books, while BTC dipped less proportionally before stabilizing. That's classic deleveraging. Safest asset, BTC, holds value better in panic. Altcoins get hammered. Exchange flows and on-chain metrics. On-chain scanners and Arkham, Look On-Chain threads recorded massive wallet movements, SEX inflows, and wallet level liquidations. Big wallet moves and sudden exchange inflows are red flags that liquidity is being mobilized. All of these metrics didn't just dip for a day. They reset. That means traders and institutions who were long and highly levered now have less margin in the system. Open interest is lower, funding rates normalize lower, and much of the easy leverage was removed. So let's get into why a reset actually clears the path for a future blow off top. Put simply, markets aren't simple. The violent stuff hurts, but historically these blowouts often serve as cleansing events. Deleveraging resets risk. Too much leverage is like dry tinder. When it burns, prices fall fast, but after a purge, the market can rebuild with cleaner positioning and fewer fragile levered bets. Analysts noted that the wipeout removed a huge chunk of long leverage. That reduces the probability of a similar cascade in the immediate future until leverage rebuilds. Volume liquidity redistribution. After a crash, the strongest liquidity providers and smartest desks buy weakness. That accumulation often sees the next rally. In this event, some top traders on Hyperliquid reportedly profited massively while many retail accounts were wiped. CoinDesk reported the top 100 Hyperliquid traders were up billions collectively. That's who buys the dip. Psychology flip. A reset forces participants to recalibrate risk. When fear eventually fades and risk appetite returns, it can do so aggressively, setting the stage for a blow-off top, since there's now pent-up demand and less easy leverage to keep prices stable on the way up. Looking at past cycles, 2017's run ended with a manic top, then a cleansing crash. 2020 to 2021 had heavy institutional inflows that pushed prices higher, followed by sharp corrections and deleveragings that set the base for the next leg. The difference now is scale. This single day wipeout exceeded previous combined events, so the clearing is wider and the subsequent rebuild could be powerful if macro conditions turn constructive. We'll compare on-chain metrics next chapter. Let's look at the human cost, influencers and ordinary traders. This crash wasn't just charts and data, it took real money from real people. Millions wiped from retail accounts. Exchanges and ledger data show over 1.6 million traders liquidated across platforms. Some accounts lost 6 or 7 figures. CoinGlass and CoinDesk flagged hundreds of accounts wiped beyond $100,000 and more than 200 accounts losing over $1 million each on certain platforms. Influencers publicly called it out. Prominent crypto commentators and traders were loud on X during the event. For example, Carl Moon and Dusty Crypto posted real-time liquidation alerts and commentary showing huge liquidation figures and extreme volatility.
And welcome to the biggest liquidation event in crypto history. Yes, you heard that right. In the past 24 hours, we've seen the biggest dump in terms of liquidation volume ever in crypto, and that's including Bitcoin and altcoins and everything. It's been absolutely mind-blowing. It's much bigger than the COVID dump, much bigger than the FTX dump, way bigger in fact. This was actually very shocking to even myself, because I did not expect this, I must say. And I can tell you right now, I lost almost every single position I had open. I'm gonna show you the only position that is still open. I'll show you right now. But I lost millions of dollars. If I made some quick calculation, I think that in terms of open positions with unrealized gains, it must have been at least $6-7 million that I lost in the past 12 hours even. So I lost more than you. I lost probably, let's say, 7 million. Maybe you lost 70,000, maybe 7,000. Long story short, we're all in the same boat. We all lost a lot of money.
I have lost millions of dollars over the past 48 hours, mostly due to the orange man, Mr. Donald Trump, making an announcement that for some reason cascaded the entire crypto market into the worst crash we've ever seen. There are some differing opinions out there about how severe this crash was. Was it really called a black swan event? But let me tell you, in the FTX crash or the COVID crash, what we saw in terms of liquidations was not even $2 billion. What we saw just this night was $20 billion. Why? Even though Bitcoin and ETH didn't really fall as much, they fell a lot, Bitcoin made its first minus $20,000 day candle, and Ethereum also fell below 3,000. Some people still think that wasn't that much. But let me tell you right now, some altcoins fell by 99.9%. Atom, I don't even know what price Atom is usually at, all right? I don't even know. All I know is that it fell to 0.01, practically zero. XRP was sitting comfortably at $2.80 or something and went to $1.12, $1.14 on another exchange, you name it, right? Just $1 and a little bit of change. Now, when I talk about me losing millions of dollars, there's two parts. One is my portfolio going down, right? That's just all the coins I hold. That's multiple millions of dollars. Obviously, that's all down, but that's fine. Don't really care about that as the market bounces back and forth. So even though, let's say at the start I'm down X amount of millions of dollars, right now, let's say I'm only down a few million. It's not that bad. I'm talking about losing the money. And the reason this hit me so hard, I'm still fine, right? I didn't make a video for a day because I'm just kind of recollecting the thoughts and rethinking the strategy and thinking what to do. The reason I got hit so hard is because of how severe the crash happened. And of course, when something like this happens and you're making videos all day about your crypto coins, you think, is this something I should say? Is it something I should mention? That also I, even though things look to always be good, can lose millions of dollars overnight. I thought about it for a second, then I realized, no, you know what? At the end of the day, I told y'all for a long time, my channel here is about my journey, how I'm going up in the markets basically, and what my plan is, how I'm doing it. And so the number one thing I should do is explain exactly how I lost so much, what my mistakes were, and how to prevent it. Because hopefully we can learn from this and do better. Because I always say, if you were able to make it once, you're able to make it freaking back in no time and way more than that, right? So that's the thought behind it. So let me just quickly explain what went wrong. First of all, this was a mass manipulation event is what I like to call it. And the reason I like to call it that is because there's a few strange things that happened. First of all, $20 billion got wrecked. It's such a ridiculously crazy number that I find it kind of odd. But more importantly, because some whales were depositing money minutes before the announcement from Mr. Trump. And if you're wondering, he basically said 100% tariffs on China. At the start, not that much happened. The market went down a little bit. And then after a while, all of a sudden, we saw a just absolutely crazy cascade. But here, for example, we see a whale deposited 1 minute before Donald Trump's speech announced the 100% tariff, and he shorted like crazy. A couple of others have done the exact same thing, and it's funny because some of these guys are up hundreds of millions of dollars in a freaking snap, because they started shorting just minutes before Trump made the announcement. Now, to a certain extent, I'm going to say, hey, might not be manipulation, it might be just gut feeling. Because I've actually been warned by some that Donald Trump usually does this speech at the end of the markets because the markets then can tank because of it. But again, how sure can you be about those things, right? Then again, take a look at this. So at 9:30 a.m., crypto market at 4.1 trillion, near a record. 5:20 p.m., crypto market at $3.3 trillion, down 800 billion. That's $100 billion per hour for 8 hours straight. Now, this didn't really wreck me at all. It was only, this even was also fine. It was only this one candle that absolutely rinsed me. And when we're talking about rinsing, I'm talking about my long positions not being able to hold it. So let me just quickly continue on with the manipulation and then we'll talk about it. First of all, if you've lost everything, just know you're not alone. The amount of posts I've seen, the amount of, I don't want to say the word on YouTube, but the amount of offings I've read about here is kind of staggering, you know, and that's of course really, really sad. Here we go about the numbers, by the way. 1.2 billion COVID crash, 1.6 billion FTX today, 19.16 billion. And actually a lot of shorts got wrecked as well, funnily enough, huh? I guess on the way back upwards. Here we go, for example, another coin, not sure which one this is, 420 to 0.001, basically back to zero, absolute zero. Here, a person that saved up for 6 years just got liquidated last night. And again, I'll talk about it a bit more about how red light therapy. I like that one, actually. That's a pretty funny post. That one we should skip, kind of. But so here's some more insider trading things, some more allegations. A whale. This guy has been publicly running up his account to 100 M's. He actually lost freaking $67 million overnight. Which, again, you may think it's a fool, it's crazy. Well, let me explain my story. So, if you guys know, I've been running a lot of bots, I've been running a lot of positions, and I always talk about portfolio leverage versus actual leverage. So, if you see me, which I had, let's say, a little bit over $2 million in bots, right? A little bit over, let's say, $4 million over on another exchange, a few $1 million over on Bybit. If you see my positions, just realize this. I almost always have enough money just sitting there in the account to cover it for about, let's say, 90% worth of a wreckage. And that basically means that if I have $10 million worth of positions open, I have at least $8 million in the account. Should be 10, of course, but I have at least, let's say, $8 million in the account to cover it so that it can go down significantly without me being hurt. Now, where it went wrong is that you still have to move the money into the right account, as it's always sitting in earn for me. That way you're still earning a couple $1,000s a day just from it being in earn. It's just, you know, I'm just telling you straight up. Now, where it went wrong is the fact that I didn't expect it to happen that fast on exchange like Bybit, which is why my positions got absolutely rinsed. I did open another $1 million just quickly as the market was recovering. I mean, it's not low enough. And as you can see, it's really not that staggering. I'm only cashed out a few $1,000s. And you can see my opening price was $226, mostly because I was busy trying to save my positions. And here, if you look at Bitcoin, really, if I was primarily trading Bitcoin, it didn't really step outside the range even. So this could have just been a very, very nice buy opportunity. Nothing really crazy happened too much. It's just the fact that coins like XRP absolutely took a nosedive. And here you can see it, right? So within range would have probably been about $1.48, something along those lines. But it went way below that to $1.13 or something of the sort.
Carl Moon tweeted about enormous liquidations and framed the drop as an opportunistic buy the dip moment. So the winners and losers. While many retail levered bulls were crushed, some large traders and potential orchestrators made huge gains. Hyperliquid's leaderboard data suggested top traders made vast profits while bottom accounts folded. An ugly redistribution of wealth in hours. CoinDesk highlighted that the top 100 hyperliquid traders gained about $1.69 billion collectively. After the event, Reddit, X, Telegram, and Discord lit up with threads asking the same question. Was it organic panic or manufactured? People pointed to sudden Satoshi era wallet movements and whale transfers earlier in the month that primed sellers. Concentrated SEX order book thinness on certain alt pairs that allowed ultra deep moves, and the coincidental political headline on tariffs that gave a credible external reason to spark the sell-off. Forums also charted the immediate change in metrics, an initial surge of panic selling, then a period of messy consolidation as algorithmic market makers removed liquidity, typical post-liquidation behavior. So where are the metrics pointing to now? Short term versus medium term. Short term, expect choppy price action, lower open interest and dampen leverage. Volatility will remain high, especially on thinly traded alts. Funding rates will likely stay muted until price stabilizes and confidence returns. Traders will be cautious about adding new leverage longs until liquidity returns to books. Medium term, if macro tailwinds, that's ETF flows, institutional returns, favorable policy or lowered rates, reappear, the market is primed for a robust recovery because much of the fragile leverage has been burned off. That's the classic spring after purge pattern that prefaces explosive rallies in risk assets. Historical precedent supports this. Big cleans lead to structural rebuilding and renewed upside when liquidity returns. So let's go through a brief checklist. If you're holding or trading, here are the immediate lessons from the reset. De-risk if you're over-levered. This was the exact scenario that liquidated many accounts. Leverage is a two-edged sword. Watch funding rates and open interest before adding leverage. They tell you if you're buying into a slim market. Follow exchange flow data or on-chain movement. Sudden wallet inflows to sexes and large whale transfers often precede big moves. If you want to stack, be patient. Market resets often provide lower entry points if you're buying for the long term. You see, this $19 billion washout was brutal, but it did what crises always do in markets. It cleansed the system of the most fragile bets, reset key metrics, and redistributed capital, often from small, levered retail holders to deep liquidity providers and big traders. That's ugly, and it costs people their life savings. But from a purely market structure point of view, it removes the tinder. If the macro picture flips positive, the market could build from here with stronger hands and a cleaner base. So yes, this was a reset. The immediate pain is real. The path forward depends on capital flows, institutional demand, and whether regulators step in to probe exchange behavior. For now, the metrics are telling traders to be cautious. But saying that the market can't rally from a clean base would be short-sighted. History suggests the opposite is possible. Okay, so let's move on to our predictions. What happens next after the $19 billion liquidation? Well, we just witnessed something extraordinary. Over $19 billion in leverage positions wiped out. That's not just a crash, that's a shock to the system. The question now is, what comes after the shock? We're going to lay out what we believe is most likely the alternate path and how to read the signals so you don't get blindsided again. Okay, so here's how we see it playing out. Leverage longs have mostly been flushed out. Because $19 billion came from forced liquidations, many aggressive bullish bets are already dead. That means fewer margin-fueled short squeezes and less downside gas left to burn. With the weakest hands removed, the market is less fragile to panic. Psychology reset. Many traders will sit on the sidelines shaken. They'll wait for confirmation rather than jump in too early. That cool down can quiet volatility for a bit, giving smart hands the chance to accumulate. Then once momentum returns, a wave of late entrants can drive parabolic upside. Macro tailwinds may reassert. If macro conditions improve, rate cuts, favorable regulation, institutional allocation, the market may flip from fear to greed. With leverage diminished, new capital entering might push a stronger move upward. Clean base formation. This crash may have given us a chance to form a healthier support base. If the lower lows become rejected and liquidity returns, the next leg up could be steep because there's less leftover leverage decaying in the background. In short, this reset is painful, but it may be the pressure release before the engine rolls back to life. Now that's the positive side. let's give you guys an alternate scenario where there's more blood and broader drawdowns. Of course, it's not guaranteed that the market shoots up. Here's the more cautious path. Continued macro stress. If geopolitical tensions escalate, rate hikes return, or inflation surprises us again, risk assets may stay under pressure. That could feed into continued selling pressure, especially if weak hands try re-entry prematurely. New leverage rebuild and a second collapse. If traders start piling back into the leverage too quickly, the same cascade mechanism could repeat at a lower level. This is the double dip risk. Regulatory crackdown or exchange failure. Given the size of this dump, regulators or oversight may step in. If a major SEX is revealed to have mishandled order flows or paused liquidations, it could shake trust and cause fresh capital flight. Domino effect. Liquidity vacuum in altcoins. Bitcoin might recover while smaller altcoins stay beaten down. Many cryptos could linger in range or even trend lower, especially if the capital flows are cautious. So while the blow off top is attractive, the more bearish path is not off the table. Always plan for both. But we want to be clear that what we're leaning towards is a green start to the week, followed by consolidation, then potential continuation upward if nothing catastrophic breaks. The signals to watch to validate whether a blow off top is coming or if we stall, the following. Open interest rates and funding rates. If open interest starts rising again, especially on longs, and funding rates turn positive, that's a signal new leverage plays are re-entering. Volume and liquidity return. Do exchanges and order books breathe again? Do bid-ask spreads tighten? Depth return? That indicates buyers are re-engaging. Whale or institutional inflows. Big wallets moving to exchanges or large buys showing up in order books. Macro institutional cues such as ETF flows, adoption news, regulation, rate decisions. Technical breakouts. Watch for resistance zones. If price clears major resistance with vigor, that may confirm the next leg. Sentiment shifts. Fear and greed index moves from fear to greed. Social metrics, Google trends rising again for crypto. If a majority of those signals tilt bullish while macro stays favorable, the blow-off scenario becomes more plausible. Risk mitigation and what you should do. Don't chase early. Wait for confirmation. You don't want to jump into a retracement. Use partial allocation. You don't need full exposure. Let momentum confirm itself. Keep unleveraged exposure. Let leverage be the last layer, not the first. Use stops wisely. Absolute stops rather than guessing. Stay nimble. Be ready to exit or hedge if macro cracks. Watch exchange behavior. If any central exchanges pauses, withdraws or halts, that's a red flag. In closing, the $19 billion implosion likely cleared out the worst of the leverage risk. If macro and sentiment don't betray us, a new uptrend could unfold, possibly with a blow-off climax. At worst, the market grinds sideways or sees further contraction in alts. But we're favoring green first, then decision time. But what do you think? Green Monday or Crash Monday? Drop your call in the comments, plus your target levels. We've now come to the lessons we can all learn from this event. You know, every crypto cycle has its defining moment, the one that separates the gamblers from the investors and the dreamers from the disciplined. The $19 billion liquidation event will be remembered as one of those moments because beneath all the chaos, the charts, the tweets, the panic, lies the same story that's been playing out for years. Greed, leverage, and lack of risk management. Let's start with the elephant in the room. Leverage. It's the fastest way to make money in crypto and the fastest way to lose it. For those new to this, leverage simply means borrowing extra funds to multiply your bet. 10x leverage means that for every £1 you put in, you're effectively trading with £10. Sounds incredible when the price is going your way, but the second the price drops by 10%, you're wiped out, gone, account liquidated. During this event, millions of traders, even those using so-called safe 2x or 3x leverage, got cleaned out. Because when Bitcoin drops by double digits in minutes, there's no such thing as safe leverage. That's why if there's one thing this crash exposed, it's that most traders don't understand risk. They understand reward. They understand profit screenshots, but they don't understand probability. Leverage is like fire. It can cook your food or burn your house down. In the middle of chaos, one name stood out. The blockchain backer. Yes. Now, if you've followed him for a while, you know he's not one of those moon boys screaming 500,000 Bitcoin next week. He's a technical analyst, one that's been in the game long enough to know when to play offense and when to play defense. A few days before the crash, he told his audience that after extensive chart analysis, something in the data didn't sit right with him. The market looked overheated, so he made a decision. He sold 50% of his holdings. Not all, just half. A smart hedge, a balance between staying exposed and staying safe. And what happened? He got attacked online. People accused him of spreading fear, of having paper hands, of missing the pump. But guess what? When the $19 billion liquidation hit, blockchain backer didn't lose half of his portfolio like many others did. He was protected. That's what risk management looks like in real time. It's not glamorous. It's not something influencers post about. It's not sexy. But it's what keeps you in the game long enough to win. There's one quote in trading. Amateurs think about how much they can make. Professionals think about how much they can lose. That's the difference between most traders who got liquidated last week and the handful who didn't. When looking into the psychology of greed and the illusion of control, realize that what makes this all even more painful is that many knew they were over leveraged. They just didn't think the drop would come that fast. That's the illusion of control. The biggest psychological trap in markets. You think you'll get out just in time. You won't. Nobody ever does. Because markets don't move linearly. They move violently. When the liquidation engine kicks in, when stop losses get triggered, and when exchanges start cascading positions, it's already too late. You're not selling, you're watching a liquidation notification. That's why risk management has to happen before the move, not after. The blockchain backer understood that. He didn't react, he prepared. Most traders do the opposite. They react emotionally, and emotions are the death of strategy. That's why when we look at lessons from previous collapses, these things sound familiar. It's because we've seen them before. Luna, 2022. Investors overexposed, trusting an algorithmic stablecoin that was too smart to fail. FTX, 2022. Traders left entire portfolios on centralized exchanges because it was easier. COVID, 2020. Panic selling at the bottom because the world was ending. Each of those events taught the same lessons, and yet here we are, watching traders repeat the cycle again, just with newer apps and flashier UIs. You know what that tells us? It's not the technology that fails, it's the human behavior. So here are 3 golden rules to survive the next cycle. We're going to boil it down into something practical. If you're watching this, here's your survival kit. Never use leverage unless you fully understand liquidation mechanics. And even then, only with a small portion of your capital. Think of it as a trade, not a lifestyle. Take profits and de-risk often. Don't wait for the top. Scale out gradually. A coin that doubles doesn't owe you another 10x. Keep your ego out of the market. You're not smarter than the algorithms. You're not faster than the exchanges. Humility makes you money. Ego takes it. These sound simple because they are. But the difference between surviving and blowing up isn't complexity. It's discipline. Which now brings us to the real lesson behind the $19 billion wipeout. This liquidation event wasn't just about Trump's tweet or tariffs or China. It was about how fragile the crypto market still is when greed and leverage meet uncertainty. Every trader wants to be the next success story, the next guy who turned 5K into 500K. But nobody posts the charts where they lost everything chasing that dream. This was the market's brutal reminder that risk management isn't optional. It's the only edge you'll ever have that can't be liquidated. So if you're watching this thinking, I got burned, don't beat yourself up. Every trader who lasts has a scar from a cycle like this. The trick is to learn the lesson now, not when the next crash comes, because there will be another crash. There always is. But those who understand risk, those who think like the blockchain backer, will be ready. They won't need luck. They'll have a plan. And that's where we'll leave this one. If this video helped you see the market a little clearer, make sure to hit like, drop a comment and subscribe, because here at I'm Studying Life, it's not just about watching the market, it's about understanding it. Remember, stay sharp, stay humble, and always keep studying.